happy Friday, and thank you for joining us during your lunch break to discuss some topics in real estate. I have Mark Prather today with us, and he is one of the leaders in industries and mortgages and real estate, and he has over 40 years experience. And I will just let him introduce himself and talk a little bit about what he's doing and what is his specialty. So Mark,
Okay.
please.
All right. Thank you, Anna. All right. So let's go to the next slide. Let's get our little PowerPoint here going. All right. Let's go to the next one. All right. This is me. As you can see, I'm the founder of Mark One Mortgage and the Mark One Real Estate Wealth Academy. Now, I've been in the real estate industry, you can see, since 1977. I got my real estate license when I was 18 and started selling houses for about a year, and then I got exposed to the mortgage industry, moved over to the loan side, became a loan officer, did well, and then at 22 started my own company, Mark One Mortgage, which I've had ever since. So it's been a little over 40 years now. But over my long journey in this industry, both as selling houses, doing loans, investing in real estate, and on the finance side, where my career and my journey is a little unique is, one, the length of it, but two is I've done pretty much everything you can do in this industry, and I've done it at a very high level, and I've learned some really profound facts about wealth growth that before now just really haven't been taught. So I'm going to share with you some of these principles. And this is my book, Why the Rich Stay Rich and the Poor Stay Poor. And the reason I titled the book that is I've made the journey from zero. I don't come from a wealthy family. I come from a poor family, in fact, and an uneducated family. And the first key premise about building wealth is about what you believe. And we'll come back to that because, see, what most people believe is just simply wrong. Because we believe what we know, but there are so many things that we simply don't know. And I love this expression, we don't know what we don't know. And that's what I'm going to try to change today and kind of illuminate your mind with concepts that I promise you have not seen before. So let's go to the next slide. All right, so to start off, why renting is a financial disaster. And here's why I say that. Renting is literally the worst thing you can do financially. And you're going to see why as we get into this. Is renting is a financial disaster because building wealth, we all want to be as financially secure as we can as soon as we can and build as much wealth as possible. But here's what it really boils down to is winning the inflation game. And I'm going to show you how to do that as we go through this presentation. See, most renters are losing thousands of dollars per year. And I mean, we're talking tens of thousands. If you're paying $4,000 a month in rent, well, that's basically $48,000 a year. That's a lot of money to pour into something that's never going to give you any return. The majority of renters are never able to retire because here's why. They're losing the inflation battle. And I'll show you the numbers on this in just a moment. And that rent payments never end. You can never pay your rent off, and it never stops going up. The inflation rate, in fact, for rents over the last couple of years, we've seen everything skyrocket the last couple of years. Well,
Yeah.
rents in certain communities have gone up 20 to 30% a year. Now, depending on what market you're in, most of California ranges from about 4 to 5%. But high income areas, high demand areas, it's dramatically higher than that. But here's an analysis on rents where I started out, if you're paying $4,500 a month, at a 4.5% annual rent increase, you can see the rent growth. Now in 10 years, you can see $4,500 grows to $6,988, basically about $7,000 a month. So this, again, is a ton of money that is just lost money. This is a lot of money to just basically lose. There's never going to be a return on it. In 15 years, we're at 8709. In 20 years, 10,000. Oh, I'm sorry, in 20 years, yeah, 10,853. So this is kind of an illustration of the compounding of rents. And I like to share this personal story. When I moved out of my parents' house when I was a kid, I was 18 years old. Me and a high school friend rented a 2-bedroom apartment in a nice apartment complex, and we split the rent, and it was a whopping $315 a month. That place, I was paying 160, and he was paying like 155. That same place today rents for 3,000 a month.
What was the minimum wage back then?
I'm sorry, what was the name? What?
Minimum wage.
Oh, the minimum wage, God, was probably 250 an hour, something like that.
So 160 is a lot of money.
Yeah. Oh, yeah, for sure. But no one thinks in those terms of, hey, that one day 315 is going to be 3,000.
Yeah.
But that's what inflation's about, and it really again comes down to money is it's like it's like playing Monopoly, right? Money is a game about numbers, but you have to know how to win the game of numbers. And the obstacle is you have to know what the enemy is. Who are you competing with? And the enemy is inflation, so you have to know how to win the inflation game, and I'm going to show you that. Now, this is from today's Wall Street Journal. Inflation eclipses April's historically strong wage gain. Rise of 5.5% in average hourly earnings compares with consumer price gains above 8%. So even as well as employee wages have been going up, the wealth creation, because of the strong economy, because of the Fed putting all this money in, as well as it's been, the people are still losing. And the people that are losing the most are the renters.
Yeah.
And the reason is because they don't have the assets. And let me show you the difference here. This is an analysis. We've all been taught the same thing, which is get a good education, get a good job, and then we got to save a ton of money. But I am telling you, let me show you the math on this. That is not the best strategy. Let's say someone's 40 years old and they want to retire in 25 years. Their current monthly expenses are $8,000, so this is their rent or house payment, utility bills, all their expenses. And they're saving $2,000 a month. Now, the average person in this country saves nothing. 50% of the people in this country save no money.
Yeah, I was going to say, well, that's a very optimistic 2,000 a month.
Yeah. In fact, I don't know. Do you have a feel, Anna, for what your average client saves per month?
Well, I have pretty savvy clients. Majority of them do maximize their IRA accounts or 401ks, and they do save. But I'm talking about average person in the United States. I'm in Silicon Valley, so a lot of people here are, very.
Well, I can tell you, the clients that we have are pretty much middle income Americans for the most part. That's the norm, because there's more of them, and they're lucky if they save. Most are averaging around 500 a month. 1,000's a lot. But in this scenario, you can see we use 2,000 a month. They're just kind of getting started, so they have $50,000 in their retirement account. We're using a 3.5% inflation rate. Right now, inflation is running 7-8%. Historically, for the whole country, 3% is the 100-year average of inflation. But if you live in a high-cost area, you're looking at more like 4.5% inflation rate. So in the Silicon Valley, 3.5% is a very conservative number.
Yeah.
And anticipated rate of return, here's why I use 4.5%. Historically, the S&P 500 has been about 8%. But if you're working with a 401k and a financial advisor, they're going to diversify your money generally in 4 categories. So one is they'll put maybe 10%, 20% max in an aggressive growth fund, then a moderate fund, then they'll put something in a conservative, and then lastly they'll put something in fixed income. When you add them all together, you're lucky if you're getting 5.5%. Then these people don't work for free, so now they're charging you 1.5%, so you end up at 4.5%. Here's where this person is going to end up in 25 years. They're going to have $1,259,000 in their retirement account. Now, keep in mind, they haven't paid income tax on this yet. For most of them, it goes into their 401k. So my point is this. About a third of this isn't even their money. They owe the federal government and the state income taxes. Their annual expenses have more than doubled because of inflation.
Mm-hmm.
If you simply divide those two numbers out, you can see they're going to run out of money in 5.5 years if they were to retire. Their earnings on the $1,259,000 is $12,724. Their monthly expenses are now basically $19,000 a month. Now, here's another important factor. And this is why understanding the inflation battle is so critical. If your expenses in 25 years are $19,000 a month, what do you think the income is that you're going to need before tax? You got to pay federal and state tax. It's going to be somewhere in the neighborhood of between 25 and 30,000 a month. So you can see we have a $14,000 shortage on this. If you just look at that number, the 4,700, you add Social Security, the person's going to need to have minimum 15, 16,000 a month in before tax income. This is why saving your way there, you're losing the inflation battle.
Yeah.
Okay, now, if your expenses are 18,906 and you average a 4.5% return, you're going to need to save about $5 million over 25 years, which means you need to save about $5,500, $5,600 a month. The average person can't save anywhere close to that. So this, again, is why renting is a financial disaster, because you're losing the inflation battle. Before I go on, Anna, do you have anything you want to add to that?
No, I'm very, I'm happy that you're showing exact numbers, because most people just in denial, and they look at just this monthly payment, and they tell me a lot of times, well, but I pay 5,000 to rent, but if I buy, I need to pay, 8 or more thousand for my own home, and they don't see the benefit, not only, sheltering money from inflation, but also all the other benefits of, that real estate has, taxes and appreciation and everything. So they just narrow tunnel vision. So I'm glad we've broken those numbers down. Gonna help.
Yeah, it's really, it's so critical. The big misnomer, I was really going to click on that hardware thing. The big misunderstanding that people have about real estate is they try to compare real estate to stocks and make an apples and apples comparison, and it's not remotely close. And let me explain why. See, real estate is the fastest and it is the safest way to build wealth, and it's close. I'm going to show you why. It's because of these 5 economic benefits. I'm going to show you how these 5 economic benefits work. So we can grow wealth typically we can grow wealth at 3 to 4 times the speed of the stock market pretty easily through real estate. And let me show you why that's true and how these 5 economic benefits work. So let's say that these red chips represent your money. So let's say you put $1 in a 401k and you get 8%. So here's 8%. Okay, so there's 8%. So $1 goes in your 401k, you get an 8% return. Here's the problem with putting money into a retirement account. Problem number 1 is you got to save this money, and as you're putting this money, you start from zero and you're saving this money. But when you reach a place where you want to pull this out, you got to pay the income tax, the federal and state income tax on that. Problem number 2 is that it doesn't help you along the way. So if you're younger, there's no income in your 20s, 30s, 40s, or even 50s, not till you're 59 and a half. So the saving is like another bill. It's a financial burden, frankly. And there's no income, because if you try to pull the income, they're going to hit you with a big penalty of 10% on that. So you have the burden of the expense and no supplemental income along the way on your life journey.
And that's one of the reasons why a lot of people don't save, because they don't see their future self. They just concentrating on today's needs, and they thinking, okay, I'm going to think about it later, because they don't see the benefit of it right now.
That's exactly right. That's exactly right. And it's such a burden, because the saving money, it's like another big bill, right? So it's really restricting their lifestyle and their quality of life. And if you have kids and school education, all those kinds of expenses, it makes it really challenging. But here's the biggest problem, and this is why I created this poker chip presentation, this is called linear wealth growth, meaning you're making money in a straight line. You're only making money on your money. This is like the slow boat to China. I mean, it's a very long, slow, arduous process to build wealth. Let's compare it to real estate. Now, let's say we take another dollar and we buy a $10 property. So just $1 like the stock market, we buy a $10 property. So here we borrow 9 from the bank. Now, you don't necessarily have to put 10%. There's 3%, 5%, 10%. A lot of people think you have to put 20%. You do not have to put 20%. But in this exercise, just so we have an apples and apples comparison, we're just going to use the $1, just like the stocks, 10%. First economic benefit is leverage. You borrow the $9 from the bank. So here's the first huge advantage, is you're not starting from 1, you're starting from 10. So you have this enormous head start. So now you have this $10 asset versus $1. But even though the bank has loaned you 90% of the money, you own 100% of the property. And here's why that's significant, is you get to keep 100% of the profits. Bank doesn't get any of the profits. They get their interest, which has been around 3%. Now it's upwards of 5%. The rates have gone up a little bit. But it is a small price to pay for you getting, I mean, think about this. Would you loan someone 90% of a property and get zero ownership interest for 5% and take all that risk? I wouldn't do it, but that's what banks do every day. So now you have this $10 asset. First economic benefit is leverage. Next is appreciation. Now in the stocks, we said 8%. California real estate, the historical average dating back to 1968 is 7.3%.
Mhm.
I'm only going to use 5%. So the average for 54 years is 7.3, but I'm going to be super conservative. I'm actually kind of stacking the deck in favor of stocks. We're only going to use 5%. So 5% of $1 is 5 cents, but 5% of 10 is 50. So let me show you what that looks like. You got 10, 20, 30, 40, and 50. Now, we've only used 2 economic benefits and we've blown away the stock market already. The leverage and the appreciation rate. It's not even close. This is why I say, through real estate, you can grow your wealth on average 3 to 4 times the speed of the stock market. That is really easy to do. But most people don't know that. Most people, because they don't know it, they don't believe it. They think, oh, and here's what a financial planner will tell someone, and I don't mean this to be derogatory, but this is the truth. Financial planners don't understand the 5 economic benefits any more than the average consumer does, because they're just not trained in real estate wealth growth. But here's what a financial advisor would tell you. Why would you want to go into real estate if the average growth rate in California is 7.3 and the S&P 500 is 8%? But see, all they're talking about is one economic factor. We still have 3 more to go. We've covered the leverage, we've covered depreciation, and we've already blown away the stock market. Now, let me show you what the other 3 are. The next is principal reduction. So here's what that means. Every time you make a mortgage payment, about 30% of that mortgage payment is principal reduction. So your loan balance is going down, so you're saving, you're basically saving money and building more equity in the property. Now, the next element is the tax benefits. Now, if it's your home, you can write off up to $750,000 of the mortgage interest on that. But here's where the other huge financial advantage that real estate has over stocks is what you want to do is get into a property as soon as you possibly can, and then as soon as you can, get to the next property. Turn your house into a rental, and whether your house is a condo or a townhouse or whatever, but get into the next one, and here's why. Because when it becomes a rental, you get this huge tax write-off of what's called depreciation. So you no longer have the $750,000 limitation on the mortgage. You can write off all the mortgage interest. You can write off property taxes, any other expenses. But the depreciation deduction is a huge number that is tied to the structure value. So typically, you can talk to a CPA, but typically CPAs will use about 75% of a property's value. So in other words, if the property is worth $1 million, they'll take 75% of that, which is $750,000, and then they'll depreciate that over a 27.5 year. So then that equals your monthly depreciation. And what that means is, as you're creating income today, remember we said with 401k, you can't get any income until you're 59 and a half. With a rental, you can get income today, and you bump rents every year, so you're getting more and more income today, making your life better. And it's tax-free. And the reason it's tax-free is because of the depreciation. Compare that to the 401k. You can't get income Today, if you took the income today, you got to pay full income tax, and they're going to add a 10% penalty on top of that. And here's the last economic benefit. The last economic benefit is rental cash flow. Now, here's what's so profound about the rental cash flow is that, and you can see with all 5 economic benefits, it's not close to stocks. But here's what's so powerful and profound about the rental cash flow and how it's different. If you put your money in stocks, you get stock certificates. What can you use those stock certificates for? And the answer is nothing. They're just paper. But if you put your money in real estate, you own land and you own a structure. You have a tangible asset. Because you have this tangible asset, either you can use it, which means there's a utility value, or you can sell the utility value to a tenant and collect rent. That's huge, right? Because there's no utility value in stocks. I call the utility value of real estate the secret sauce to real estate. It is the combination of the 5 economic benefits and the utility value is why real estate blows away stocks. Now, with this utility value, here's the other powerful point. If you were to borrow money and buy stocks, who would pay off your stocks? Who would pay off that loan? If you borrowed 100 grand, bought $100,000 Google stock, who's paid off for you? Answer, no one. Why? Because there's nothing in it for them.
Right.
But if a bank loans you money to buy a property, then you sell the utility value to a renter and they pay you rent. So if I loaned you this money and someone else pays off my loan, doesn't that make the money I loaned you free money to you?
Yeah.
And the answer is absolutely. Name one other way that you can create millions of dollars of free money. And the younger you are, the more free money you can create.
Right.
This is really the X factor. Now, before I go on any further, Anna, do you want to add anything to that?
Well, I want to add that a lot of people looking at this and thinking, okay, well, but I don't have the down payment money, or there is no cash flow right now in this current market, right? Because the prices are going so high. But I want to point out that, first of all, a lot of people don't know that they can use their 401k for down payment for primary residence. That's number one. You can leverage one vehicle to invest in the other. And secondary, even if you do not have cash flow right from the start, you still get to enjoy the other 4 economic benefits. So, and cash flow will be there in few years anyway.
Oh, absolutely. Yeah, and the key point, because of these 5 economic benefits, is you're winning the inflation battle, you're not losing it. Where when you're renting, you're losing. I mean, you're literally losing money every single day. Because here's another kind of simple analysis to do. And this is to try to make a more apples and apples comparison between stocks and real estate.
Mm-hmm.
All right, let's say you have $100,000 in a stock, and you make 8%. So you got $8,000 return. Well, here's the thing, though. You can't live in that stock, right? So you have to pay rent.
Correct.
So that rent cost, if you deduct that rent cost off of your return on investment on your stocks, because you're paying it, right? You got to pay for a place to live in.
Right.
You're actually going backwards. Renters are losing money and they don't even know it. Where when you buy a property, you have this asset, not the stock, and you get the utility value so you can live in it. So when you factor that into the equation, it creates, a dramatic return. Let's go ahead and advance this slide for me. Okay. All right. Now, this is what we call our forecaster report. Now, I'll show you how some numbers that we've run. And this is what we do on every with all our borrowers as far as getting them pre-approved and pre-qualified and all those things. But this is our real estate forecaster modeling. So let's say you bought a property for $1.5 million, put 20% down. And by the way, as to Anna's point, is that there's all kinds of programs. You don't need to put 20% down. You can get in with 10%, 5% to probably about $1 million. I don't know if we can go to $1.5 million with 5%. I know we can go up to about $1 million at that level. But in any case, this scenario is 20% down. So the loan balance is $1.2 million, down payment $300,000. Now, if you're living in the property, you're not collecting the rent, but it's critically important that we understand what the street value is for renting the property, because that's the utility value that you're enjoying. Because if you didn't own it, you'd be paying that rent, all right? So
Right.
you're getting that value. Now, we've used a 4% appreciation rate on the market value, not the 7.3, so it's very conservative. The
And
rent compounding at 4.5%, but you can see how the property value is going up. So over 10 years, the
yeah,
property value goes from 1.5 to 2.2. Now, over the last 2 years, property values have been about 20% a year. So you can see 4% super conservative. But look what
right.
happened to the 300,000. It's 1,229,000. And again, here's what is so profound about this is you are growing wealth dramatically faster than you are through the stock market without the burden of saving money. It's just happening on autopilot. And your mortgage payment is fixed, but the rent values around you are not fixed. The rent values, because of inflation, are steadily rising. And this is why what we want to do as soon as possible, and what defines as soon as possible is tied to your affordability, right? How much money you're making and all that. But we want it as soon as possible. And for most people, it's usually around 4 or 5 years. High income earners, it can be 2 or 3, but the average person, 4 or 5 years, where they can rent their property and then the rental income will cover the mortgage payment and then they can move on to the next property. And if they've been able to save money, they can use that to buy the next property. If they haven't been able to save money, we can get them a home equity line and pull some money out, and they don't need to pull very much money to go buy the next property. But you can see the wealth growth on the property and the income growth, and you look at the compounded rate of return. The
Yeah.
Nasdaq's down over 20% year to date. Bank of America is projecting that the stock market, the S&P 500, will have 0% growth net for the next 10 years. Zero. That's what B of A is saying, and so far they've been real accurate. They were projecting the S&P 500 to lose 10% this year. They are low on that number. S&P 500 is about 13% down, and it's going to grow more. All right, let's go to the next slide, Serena.
Yeah. And I'm a living example of what you just mentioned. I used equity from my home to buy investment property.
Yeah,
And
yeah, that's what you want to do. All
it's
right, so here's the $1,000,000 question: is when is a good time to buy? And this is the number one mistake people make. Again, as I said in the beginning, I know you want to build as much wealth as possible because we all do. But here's the truth: financial literacy in this country is just it's just not taught. It's not taught in high school
yeah,
unless you're a business finance major. You haven't really got much of it. And the things that I have learned, some of the things I've shared with you, the 5 economic benefits, the utility value. You know where I learned that? No
on your
class, no book, with my own money, the hard
right.
way. All
Yeah.
right. A lot of things I'm sharing with you today that I've just never seen anybody else teach them.
Yeah.
Here's the point I'm making is that the key to making money, it's not about the market around you.
Mm-hmm.
Okay. See, when you buy stocks, if you or I want to buy stocks right now, and we want to go buy Apple stock or Google or whatever, you and I are going to execute basically the same price if we buy stocks are the same price at any given time. That
Yeah.
is not true with real estate. See, you can't negotiate a better deal with Google than I can negotiate. That when it's a good time to buy is when you get a good buy. And I'm going to share with you right now as we get through this. See, value is largely driven by supply and demand. Now, if we look back, remember I said in March of 2020,
Mm-hmm.
demand was collapsing because of the fear of COVID. And those people that bought and pulled the trigger anyway got screaming deals because demand was low. But why did they get a screaming deal? Why
People
was
were
demand low?
people
Because
were paralyzed with fear of unknown.
yeah, people are afraid.
Yeah.
See, the herd mentality, people move in a herd. Why do they move in a herd? Because they're afraid. And why are they afraid? Because they don't know any better.
Mm-hmm.
You don't want to be part of the herd. You want it to be, it's called contrarian investing. The people that make the most money are the people that are the contrarians, where they step out of the herd and they get informed. They're not just, taking random guesses. No, they get informed. All right, so see, as I said, real estate is so different from stocks because, see, every seller is different. So let me give you an example. Let's say there's 10 different properties on the market and they're going to have 10 different sellers. Well, those 10 different sellers are going to have 10 different motivation levels to sell.
Correct.
And Anna, I'm sure will tell you, you have people that don't really want to sell, don't really want to move. I think they're just bored. They list their house, they put it
Yeah,
on the market, they put a ridiculous price.
right.
An agent will take the listing and throw it out there because they want to get some leads, and they know it's never going to sell, but if they have a listing out there, they'll get a few phone calls. So they list it. And it's 20%, 30% over market.
Mhm.
There's no motivation to sell. That's a waste of time. But then we start going to the other. So let's say 10 are the people that have no interest in selling. But then we go the other direction. There are 10 to 20% of the sellers out there that have to sell. I mean,
Yeah.
and they have to sell fast. And that is in every market. Maybe they lost their job. Maybe, they got sick. Maybe they got transferred to another part of the country. Maybe, I mean, people are fleeing out of California like you can't believe, going to all these different states,
Mhm.
and for different reasons. Some of it's politics, some of it's, high cost, whatever the reason, doesn't matter. But, if someone says, look, I'm getting out of Dodge, I got to go. But
Yeah.
here's my point, is the motivation level is from 1 to 10. People being, from being not motivated at all to being, I have to sell, I have to move. So that's when you want to pull the trigger. And when the market starts to shift, see, over the last 2 years, we've been in a place where for every listing, there's been 10 buyers.
Minimum.
Yeah, it's been crazy, right? You're not going to get a good deal in that environment. But the market's shifting, and it's shifting for different reasons. Prices have gone way up, interest rates have moved up, but here's the number one thing that's causing the shift, is people are losing money in the stock market. When people start losing money in the stock market, there's nothing that affects people's psychology more than the stock market. Because they look and they said, I had 100 grand 2 weeks ago, and now I have 90 grand, and then 2 weeks later I have 80 grand, and they're like, oh my God, how long is it, and they just go into lockdown mode, mental fear lockdown mode.
Or
And
the
that's
interest,
okay.
people afraid of rising interest rate. But the interest rate, even though it's higher than it was for the last 2 years, it's still lower than the inflation rate.
Yes, absolutely, it's lower than inflation, and property values are projected to go up 8 to 9% this year.
Right.
But here's the other thing about interest rates. Now, if you look historically, historically, normal interest rates in this country are about 7 to 8%, and I'm talking dating back into the 1800s. I read a great book by Andrew Carnegie about his life story and how they were, in the 1800s they were about 8%. We are still looking at historically dramatically low rates, in this 5% range.
Mhm.
The other point is you're not going to live necessarily with a 5% rate forever. You
Exactly.
get into the property, you're going to enjoy all those 5 economic benefits. And if rates come down a year from now, you can get a 0.0 fee refinance and drop it if the opportunity is there. If it doesn't, then you're still at a great rate over the long haul. But again, the bottom line comes down to this. Here are the two most important factors. Is number one is you're winning the inflation battle. You're not losing. Every day you're renting, you're losing the inflation battle. You are losing money. I don't care how well you're doing on your stocks. Because of the lack of the utility value, you're losing money. You are losing the inflation battle if you're renting. We have to win that. That's number one. Number two is as the market shifts, that is a good thing, not a bad thing, because you have the opportunity
Mhm.
to get a great deal. So here's the question I have for you. If you can buy real estate at a discount, where over the last 2 years, if a property went on the market, and just to throw out a number, it's $1 million property, it got
Mhm.
listed at $1 million. Anna, if a property was listed for $1 million, what did it sell for?
Well, it could sell anywhere from 1.2 to 1.5 million,
Yeah.
or
Yeah, they didn't
like
get deals.
200 or 500 over us.
Yeah, they paid a premium. Why did they pay a premium?
Low
Because
rate.
the demand was so high, because people were moving in this herd. We're reaching an equilibrium at a place where you're going to be able to get deals. But here's the key is how do you find out? All right. How do you find out who's the most motivated? And here's the answer. Is do you think, let's say someone got a job transfer, and so we're in early May, and their job says you have to be here by July 1 to start your job.
Mhm.
So they have to sell it in May and close escrow and get moved, and they basically in their mind they're thinking, I got to get this thing sold within a week or two, and I got 30-day escrow, I got to get this done, and I got to get packed up, and we got to get out of here by June 15th so I can start my new job July 1. Do you think they're going to put an ad in the listing agent say, my seller has to be start his new job July 1, so he must sell by May 15th. We are desperate, so please bring your best offer. You
No,
ever
but
seen that kind of ad? They're not going to do that, right? See, buying real estate is like, it's like buying anything else. When you go to a flea market or a swap meet, every table has a different seller, right? All of them have different motivations to sell, and all of them you have to get to find out what they're going to buy, what they're going to take as a seller, is you have to make them an offer.
right. And of course, as an agent, my job is to find out as much as I can from the listing agent what is seller circumstances. And believe it or not, a lot of agents will share my client moving to Florida, they need to sell, or my client is, getting divorced. So then you can already understand that it is urgent. Or I had agents saying they don't need to sell. They want to get this price, and if they don't get this price, they're not going to sell. Then it's a different game.
Yeah, and I agree with you, Anna. I mean, that's important, so she can get as much information. And, when you're dealing with the listing agent, there are, different, I found different agents have different philosophies. Some of them will, be real close to the vest because they kind of look at it as, they want to negotiate the best price and they won't communicate a lot. And some are just the opposite. They'll say, hey, my client's really motivated. We want to get this done. So please bring us something. But Anna can do that research for you. But here's, what it comes down to is you have to make an offer and you have to start the conversation because that's when you're really going to find out.
Yeah.
And if I'm a seller, I'm not necessarily going to be all that forthcoming with my agent
Hmm.
because I don't want the agent to think I'm that desperate. If I know I have to sell, I'm not going to tell my agent, oh my God, I need to sell within a week. Can you please make this happen? I'm not going to do that. I mean, because I don't want to be taken advantage of. Is really the bottom line, right? So that's where, in the process, the first step to all this is we need to get you pre-approved so you know your buying power. We need to establish that number. What is your ceiling? Now, you don't have to buy at the ceiling, but we want to establish what's the ceiling. Whatever that number is, get you pre-approved, and you have a formal pre-approval letter. We get that to Anna, and then Anna knows where to work from. So then what would you say is the next step for you from there?
Well, next step, we're gonna discuss what's your wants and needs and dreams, and we'll make a list, and then we'll go look for properties. But again, you're right. There is no point of going looking for homes. That's what people start doing. They going online on Zillow and they start going to open houses without having financial clarity and having pre-approval. So first thing, of course, is a pre-approval. Then we having a meeting and a conversation about what you're looking for, and we try to narrow down because if we're going to run around, across the whole Bay Area, looking here and looking there without specific target, we're going to just waste time and we're going to miss the right one. So we want to narrow down as much as we can, and that's why we need to have this conversation and help me understand what you need and help you understand what your needs are, because a lot of people don't have that clear picture of what are they looking for, and that's why for some people it takes much longer than for others because they don't have that clarity. So we want to make it very, very clear, and then we're going to start looking, physically go and look at homes.
Now, the other thing I just want to comment on is that I know, in your marketplace, and you have a lot of high income earners. I have another presentation called How to Build a $10 Million Net Worth Through Real Estate. what is possible. You've just seen the tip of the iceberg. If this is interesting to you and you want to learn about how you can build this 10 million in your marketplace, and 10 million is easy. The number should be more like 20 million. Because in my presentation, what I show is a step-by-step strategy on how, starting at a $750,000 purchase, a person over 20 years, without saving any money, without ever putting any more down, they start with buying 5% down, $750,000 property, and over a 20-year timeline, they turn it into well over $10 million in net worth and in income. It's a dramatic amount of income. So in your market, that number, we can double it pretty safely to a $20 million net worth. So if you're interested in that, then I'd love to just share with you that.
I think a lot of people would love to hear about this, and we definitely going to have another um, live event like this and talk about it. Unfortunately, we were not able to stream live on my Facebook, but I will post this recording, and I'm sure a lot of people will benefit. And I'm eager to have this conversation about building wealth. But the first step is getting out of renting.
Yeah, absolutely, absolutely. All right, well, Anna, that's all I have. Do you have anything else you want to address?
Thank you so much, Mark. No, and again, as you mentioned, reevaluate, why are you renting? Is this the right time for you to start looking at the property? And remember, it doesn't have to be the perfect home. It just to get you out of the rent, and it's just a first step. So don't look at it. It's like your forever home. It's usually not. Your first home is most of the times is not your last home. So if you have any questions about mortgages, if you want to talk to Mark, we will gonna leave links under this video. You can contact him directly. And if you want to start looking at real estate here in the Bay Area, you have something to sell, contact me. Or if you just have questions and you want to see if this is the right time for you to jump into this market, let's schedule an appointment, and I would love to check your specific situation.
Oh, Anna, you just remind me something real quick is that I forgot to mention is that we do free online personal wealth consultations. So here's what that means basically in a nutshell is if you want to learn step by step what is possible as far as through real estate, how much wealth you can create from whatever basis. If you're a renter with $50,000 or more, if you're a homeowner, I will show you step by step how over different time. One, I mentioned the how to build a $10 million net worth. Well, another strategy we have is for seniors, which is seniors how to retire within 5 years. We have a senior homeowner program. So if you're a senior, meaning let's say 62 years of age or older, and you're concerned about retirement, we can show you as a senior homeowner how we can get you to retirement within 5 years. There are so many things that are possible for your life as far as wealth growth, financial security, that people just aren't aware because no one teaches this stuff about the 5 economic benefits and how to manipulate all these moving parts, the finance and so on, in different ways. There's just we've only scratched the surface. We can dive into this in a free online consultation. It takes about 45 minutes. So just reach out to Anna, and you can see my contact information. But this is something that we can, the three of us can do.
And that you jump on this opportunity. I had this consultation for myself, and it's just, you cannot get those consultations for free. It's a huge value, and I highly recommend you do this. It costs you nothing. You have no obligation, and it's just going to open your eyes to opportunities. So do that. You have nothing to lose.
All right. All right. Thanks again, Anna. Appreciate it.
And we'll do this again, Mark, for sure. Thank you for your time.
Oh, it's my pleasure. All right. Have a great week.